If Iran were to attack Israel, it could trigger a complex and highly volatile set of reactions globally, particularly in the financial and commodity markets. Here's an outline of potential impacts on the stock market and economy. 1. Stock market volatility and declines. Initial panic. The immediate response would likely be a sharp decline in global stock markets, especially in countries with strong economic ties to the region, like Europe, the United States, and some parts of Asia. Safe haven investments rise. Investors may quickly move capital to traditionally safe assets like gold, the US dollar, and Treasury bonds. Safe haven sectors, such as defense and cybersecurity stocks, may also see a boost. Sectoral impacts. Energy sector oil and gas companies could see spikes in stock prices due to the potential disruption in oil supply. Defense contractors, stocks of defense contractors could increase as governments may increase military spending in response to rising geopolitical tensions. Airline and tourism sectors. These sectors would likely see a steep decline as travel risks increase in the Middle East and beyond. 2. Oil and energy market impact. Rising oil prices. Iran's strategic position near the Strait of Hormuz, a key choke point for global oil, means any conflict could disrupt oil flows, causing a sharp increase in oil prices. Oil prices could skyrocket, especially if transportation routes are compromised. Gas prices. Natural gas markets, especially in Europe, might experience further strain as they are already impacted by limited supply channels and rising demand. Economic consequences. Higher energy costs would likely lead to inflation in many regions, affecting the prices of goods and services globally. Central banks could be forced to adjust interest rates to stabilize inflation and manage the economic fallout. The specifics would depend on inflation's severity and the impact on economic growth. If energy prices remain high for an extended period, it could reduce consumer spending and industrial production, leading to slower economic growth. Geopolitical responses and market reactions. Countries with close alliances to either Iran or Israel could become directly or indirectly involved. Potential sanctions or trade restrictions could impact trade, specifically affecting companies with exposure to these regions. Currencies from countries perceived as safe, such as the US dollar, Swiss franc, or Japanese yen, might appreciate due to capital flight from riskier markets. The ongoing geopolitical tension could disrupt the global supply chains, particularly in sectors that rely heavily on Middle Eastern raw materials. Long-term market adjustments. The event could accelerate investment in renewable energy and diversification away from Middle Eastern oil dependency, impacting traditional energy stocks while boosting renewables. Countries may increase defense budgets, benefiting defense contractors and cybersecurity firms over the longer term. Summary of market scenarios. First, a short-term shock, immediate market panic, a rush to safe havens and sharp oil price spikes. Second, an intermediate adjustment, increased inflation, economic slowdown, currency adjustments, and policy responses from central banks. Third, long-term adaptation shifts toward renewable energy, changes in defense spending, and possible new geopolitical alliances. The exact outcomes would depend heavily on the conflict's scale, duration, and any international involvement or intervention that may arise.